Penthouses that once sparkled now sit empty, streets whisper of deals gone cold, and even the world's most glamorous addresses are slowing. From frozen Brussels to sun-soaked Riviera hideaways, million-dollar homes are losing their shine. Some places surprise, others shock. In the next few minutes, we'll uncover how Europe's high-end property boom is unraveling, and where opportunity might still be hiding. Stick around. You won't just see luxury retreating, you'll see where the smart buyers are stepping in. Brussels, Belgium. Luxury stalls in Europe's quiet capital. In Brussels, the calm looks deceiving. On paper, the market seems stable. Prices in places like Sablon and Ixelles still hover around $7,400 to $9,500 per square meter. But agents quietly admit it's harder to sell than it looks. Properties that used to move in a few weeks now sit for months. The European Parliament crowd that once fueled quick deals isn't buying like before. Since 2020, many high-end condos have quietly dropped their prices by 5 to 10%, though few advertise it openly. The tone among brokers feels polite but uneasy, like everyone's waiting for someone else to make the first move. Knight Frank's latest report calls it stable but softening. Still, beneath that calm, the air feels cold, and that chill only deepens the further north you go, where even frost can't hide the silence. Nordic capitals, Scandinavian cool meets market freeze. Across Scandinavia, the shine has started to fade. Stockholm's waterfront apartments that once sold in days now wait quietly, their glass walls reflecting empty streets. Prices that peaked around $1,000 per square foot in 2022 have flattened or slipped a few percent. In Oslo, even luxury homes in Frogner and Majorstuen, once snapped up by oil executives, are seeing 30% fewer sales compared to last year. Mortgage rates hovering near 5% have cooled what was once Europe's hottest real estate scene. In Copenhagen, sleek designer lofts built around 2020 still look stunning, but sellers now negotiate harder, sometimes shaving off $50,000 to $100,000 just to close a deal. For buyers with patience, this is a great opportunity to buy. And while the north freezes, the story takes a sharp turn southeast, to a city where heat brings its own kind of collapse. Istanbul, Turkey. Millionaires lost in currency chaos. In Istanbul, the view can fool you. From the hills of Bebek to the mansions lining the Bosphorus, everything looks like it should cost a fortune, and it once did. But as the Turkish lira keeps sliding, those million-dollar listings lose real value fast. In local currency, prices are up more than 40%. In dollars, though, many have quietly fallen by a third since 2022. A home once listed for $2 million might now trade closer to $1.3 million, simply because of currency chaos. Developers have started posting prices in euros to stay sane, while wealthy buyers show up with briefcases of cash to lock deals before inflation moves again. For investors holding dollars, this market isn't collapsing, it's resetting. But as Istanbul tries to steady itself further south, another so-called miracle market is beginning to tremble. Athens, Greece. Southern boom, but for how long? Athens has been one of Europe's comeback stories. After years of crisis, luxury apartments in Kolonaki and seaside homes near Glyfada finally saw life again, climbing roughly 9% in 2024. For a while, it felt like the old charm was back. But now, sellers whisper about slowing inquiries and fewer foreign calls. Golden visa buyers from China and the Middle East, once lined up for viewings, are now looking more toward Lisbon or Madrid. Still, for anyone buying in dollars, Athens feels like a rare sweet spot. Prices are steady, yet sellers are more open to negotiation than they've been in years. A well-located apartment that sold for $1.1 million last summer might now close closer to $950,000. The fundamentals look strong, but timing matters. And just north of here, another capital's swings make Athens look calm by comparison. Bucharest, Romania. Tiny market, big mood swings. Bucharest feels unpredictable, a small market where one big sale can swing the numbers. Prices in upscale areas like Primavera and Dorobanci edged up only about 2% this year, but that doesn't tell the whole story. Many listings are sitting quietly, with sellers holding firm and buyers waiting for Romania's central bank to finally ease rates. During the pandemic, cash-rich diaspora buyers drove a short boom, snapping up new penthouses for around $800,000 to $1.2 million. Now, some of those same investors are considering exits, worried the demand won't return fast enough. Still, for buyers with cash, it's a window of calm before the next climb. Developers are holding finished units, hoping to wait out the lull, which means negotiation power sits firmly with buyers. And just a few hundred kilometers west, another capital's confidence is cracking faster than expected. Warsaw, Poland. New builds rising, confidence falling. Warsaw's skyline keeps growing, but the mood on the ground is changing. Along the Vistula River, glossy towers keep rising, with luxury units averaging around $8,500 per square meter. Yet not everyone is lining up to buy. Local demand stays steady, but foreign investors, especially from Germany and the UK, have pulled back, worried about EU funding debates and Poland's shifting mortgage rates. Developers admit pre-sales are slower than last year, and some are quietly offering perks like parking spots or kitchen upgrades just to seal deals. Still, compared to Western Europe, Warsaw remains a bargain for anyone holding dollars. The fundamentals are solid, and the slowdown feels more like hesitation than decline. It's the kind of pause that rewards patient buyers. But west of Poland, the story turns sharper. A market chasing high returns that suddenly lost its nerve. Budapest, Hungary. High yields, low buyer faith. Budapest was once the darling of European investors. Its mix of history, architecture, and strong rental returns made it feel like a secret everyone wanted in on. Even now, yields above 6% look attractive on paper, especially compared to cities farther west. But behind that number, confidence has slipped. Luxury sales in District 5 in the Buda Hills have slowed sharply, with listings that once sold in weeks now sitting for months. Political uncertainty and currency swings have made foreign investors cautious. A penthouse that fetched $1.2 million in 2021 might struggle to hit $950,000 today, even as rents stay high. Locals still treat real estate as a safe hedge against inflation, but liquidity has dried up. For buyers with long-term vision, this could be a quiet opportunity. And just next door, a city once shining bright is watching its golden glow fade faster than anyone expected. Prague, Czech Republic. The golden city turns cautious. Prague still glitters, but it's a quieter kind of shine now. In Mala Strana and the Old Town, the cobblestone streets look the same, yet luxury listings have stopped moving like they used to. Prices are up just about 2% this year, but total sales are down around 15% compared to 2023. Developers have hit pause on new launches, saying construction costs make fresh projects risky. Wealthy locals, once active buyers, are shifting money into government bonds or simply waiting with cash in hand. A restored historic flat that sold for $1.4 million 2 years ago might sit unsold today, even at $1.2 million. For international buyers, that's not bad news. It's breathing room. This is a market catching its breath, but cross the border into Germany, and that slowdown turns into something far deeper and far more revealing. Munich, Germany. Wealthy, wary, and slowing down. Munich used to feel untouchable. For years, luxury apartments near the English Garden or Leopoldstrasse could sell almost overnight. But not anymore. Prices for high-end units that once went for around $21,000 per square meter are now sitting on the market longer than anyone expected. Agents quietly say buyers have disappeared, and owners are starting to feel it. Sales have slowed, even if the price tags haven't moved much yet. Locals call it the hangover after the boom. Mortgage activity has dropped to its lowest level in 10 years, and energy costs keep people cautious. You can feel it. The excitement's gone. Still, it's not a crash, it's a pause. Sellers are listening, and good deals are starting to surface. For patient buyers, Munich's slowdown could be a rare chance. But head south to Spain, and the heat tells a different story. Barcelona/Costa Brava, Spain. Sunshine can't hide the slowdown. Along Barcelona's coast, the shine of million-dollar homes is dimming. In places like Costa Brava and Sitges, beachfront villas that used to vanish from the market in days are now sitting for months. Agents say listings that once fetched over $2 million are seeing quiet price cuts. According to Knight Frank, growth in prime Spanish property has slowed to barely 2%. After Brexit, British retirees, once a key source of luxury demand, have pulled back. Meanwhile, Spanish families can't afford these homes, leaving the market leaning too hard on tourism and foreign buyers. The result is a calm surface with nerves underneath. You still see the sun, but the buzz is missing. And as you follow the coast toward the south of France, that feeling of quiet unease turns into something else, something no one expected to happen so soon. Nice, French Riviera, France, Riviera glitz, Riviera gloom. In Nice, the postcard-perfect Riviera no longer guarantees quick sales. Waterfront apartments that once sparked bidding wars now linger quietly, even as owners hold firm on their prices. At roughly $16,000 per square meter, these homes still look pricey on paper, but the real story is time. Transactions now take twice as long as they did before 2022. Currency stability has helped France more than others, yet even that can't hide the slowdown. Agents say British and Russian buyers, once key players, have vanished. Without them, the luxury market feels like a party that ended early. Savills called it resilient but cooling, a polite way of saying sellers haven't adjusted to reality yet. For patient buyers, this pause may be the chance to get in before the next wave. Because just a little farther west, even the famous red carpets are starting to roll up. Cannes, France, where red carpets meet red numbers. Cannes still dazzles, especially during festival season. Waterfront penthouses and historic villas look as glamorous as ever, but the buyers aren't showing up like they used to. Trophy homes that once flew off the market now sit for months, and overall deals are down about 25% compared to 2023. Even the glitz of the Cannes Film Festival hasn't sparked much renewed interest in luxury real estate. Agents report longer days on market and quietly trimming prices by 5 to 10% just to keep buyers engaged. A penthouse that sold for $6 million 2 years ago might now go for closer to $5.5 million. The prestige is still there, but momentum has faded, leaving opportunities for buyers willing to move patiently. And if you look across the sea, Ireland is showing a very different kind of ride, where luxury swings feel more like a roller coaster than a steady climb. Dublin, Ireland. Prime prices on a roller coaster. Dublin's luxury market has been unpredictable lately. One month, prices tick up 3%, the next they drop 2%, and sometimes they barely move at all. The roller coaster feels even steeper for mid-tier buyers, frozen out by higher mortgage rates. Corporate relocations that once brought executives and boosted demand for high-end apartments in Ballsbridge or Donnybrook are slowing down, leaving some properties sitting unsold. Savills warns that the market is rate-sensitive and volatile, and you can see it in how long listings stay on the market. Sellers still hope for peak 2022 prices, even if buyers are cautious. For those with cash and patience, these shifts create openings, deals that weren't possible just a year ago. And as Dublin catches its breath, another European city looks calm on the surface, but that calm is starting to crack in unexpected ways. Stockholm, Sweden. Nordic calm cracks beneath. Stockholm still looks calm from the outside. Sleek waterfront apartments and minimalist penthouses seem untouched, with prices expected to rise just 1 to 2% in 2025. But underneath, the market shows signs of strain. Sales volumes are low, and high borrowing costs have kept many buyers on the sidelines. Even ultra-clean modern homes in Oostermalm or Norrmalm are taking longer to sell, and agents quietly warn that one more interest rate hike could tip the balance. Knight Frank calls it fragile optimism, a polite way of saying the market is steady but tense. Buyers with cash are in a strong position. Negotiating power is shifting, and patient buyers can find deals that weren't there a year ago. And just across the North Sea, in a city known for its high-value condos, the ceiling has already been hit, leaving very little room for growth. Amsterdam, Netherlands, the Dutch high-end hits the ceiling. Amsterdam's canals still charm, and the city's high-end apartments look as picture-perfect as ever. But the market has plateaued. Prime units along Herengracht and the Jordaan hover between $12,500 and $14,500 per square meter, and sales aren't moving like they used to. Over the past 2 years, transaction volumes have dropped about 20% as locals adjust to tax reforms and tighter rental caps that make investment less attractive. International buyers, who once rushed in after 2023's recovery, are holding back. Agents describe the mood as stable, not soaring, a polite way of saying the boom has ended, but there's no panic. For cash buyers, this pause opens the door to negotiate better deals, especially on trophy apartments or classic canal homes. And as Amsterdam steadies further southwest, Portugal's golden visa market shows signs that its glow might be fading faster than anyone expected. Lisbon, Portugal. Golden visas fading, markets cooling. Lisbon's hills and pastel-colored streets still draw the eye, but the market is feeling the chill. The government's phase-out of the golden visa program has cooled demand by roughly 10 to 15%, taking some of the sparkle off prime neighborhoods like Chiado and Avenida de Liberdade. Luxury prices are still up about 4%, but growth is slowing, and buyers are becoming more selective. In Porto, boutique homes are holding value for now, but even there, foreign interest is moving towards Spain and Greece, chasing better returns. Agents say policy fatigue is real. Investors are cautious, waiting to see how rules and taxes will evolve. For patient buyers, this slowdown creates opportunities to secure Lisbon's charm at prices that might have been unreachable a few years ago. And that cautious sentiment is crossing borders. In Madrid, Spain's capital, the luxury market is starting to show the same signs of strain. Madrid, Spain, hot market, cold reality check. Madrid's streets are still lined with grand townhouses and sleek penthouses, but the market isn't as fiery as it once was. Prime homes, especially in Salamanca and Chamartín, are up about 3%, but rising mortgage costs and tighter lending are slowing buyer activity. Knight Frank calls it a balancing act, and that's exactly what agents feel on the ground. Buyers are cautious, sellers are patient. After a record 2023, developers are holding back on new projects, waiting to see if demand will hold. Some investors are shifting money to southern coastal zones, chasing holiday homes rather than city apartments. For those with cash and patience, Madrid offers the chance to step in before prices firm up again. And just a short drive away, Barcelona's market shows the same cooling trend, signaling that Spain's luxury boom is starting to pause. Barcelona, Spain. Coastal luxury faces a pause. Barcelona's luxury streets still gleam, from Eixample's grid to Pedralb's leafy avenues, but the pace has slowed. Prices hover around $10,500 per square meter, yet buyers are taking their time. Seasonal dips stretch out into soft quarters, and recent rental caps have made investors cautious. Domestic buyers, worried about political shifts and economic uncertainty, are holding back, leaving a market that's active but quieter than before. Agents describe it as healthy but tired. Properties that once sold within weeks now linger for months, giving patient buyers an opening to negotiate on price or extras. For cash-ready buyers, this pause offers a rare chance to step into one of Spain's most coveted neighborhoods without racing against bidding wars. And as Barcelona catches its breath, the spotlight moves north to Italy, where high glamour is starting to meet buyer fatigue. Milan, Italy. Fashion capital, price fatigue. Milan still dazzles with high-end boutiques and sleek penthouses, but even here, the market shows signs of slowing. In the central districts near the Duomo and Brera, prime homes hover around $10,500 per square meter, kept alive by fashion industry money and international buyers hunting prestige addresses. Yet just a few streets away, outer prime areas are starting to feel the pressure, with listings staying longer and developers holding back on new launches. Developers are also turning attention to mixed-use retail projects, signaling that residential luxury alone isn't moving as fast. The Financial Times notes that Milan's luxury sector is performing unevenly, with retail driving more activity than some residential pockets. For buyers with cash, this slowdown creates openings to secure prime addresses without rushing. And just across the Alps, Switzerland's famed stability and safety are beginning to feel a little sleepy, hinting at hidden opportunities. Zurich, Switzerland. Safe haven, slower gains. Zurich still shines as Switzerland's financial heart, with its prime neighborhoods like Seefeld and Enge holding prices around $12,000 per square meter. Luxury homes continue to see modest gains of 1 to 2%, yet buyer activity is softening as locals hesitate amid high costs and rising interest rates. International money keeps the market looking strong, but agents say caution is the real driver. Buyers aren't desperate, they're selective. Tight supply maintains the illusion of strength, making it look steady, but patient buyers might find small cracks to step in with advantage. For those willing to move carefully, Zurich offers both prestige and the rare chance to negotiate terms in a normally fast-moving market. If you're loving this tour of Europe's luxury slowdown, hit like and subscribe. There's plenty more hidden opportunities ahead you won't want to miss. Geneva, Switzerland. Luxury without liftoff. Geneva remains a stronghold of wealth, yet even here, prime properties feel heavy and slow. Apartments along the Quai du Mont Blanc or in Champel hover around $13,000 per square meter, but price growth has essentially paused in 2024. Low liquidity and strict mortgage rules keep most buyers on the sidelines, while a few trophy listings quietly cut 5 to 8% to attract attention. Agents call it a calm to the point of stagnation, with international interest steady but cautious. For buyers ready to act, this creates a rare chance. Geneva's prestige comes with a small window to negotiate while the market waits for confidence to return. A few hundred kilometers east, Europe's startup darling, Zurich's neighbor city, is showing similar fatigue. But here, innovation meets high rent, and the slowdown could reveal surprising openings for savvy buyers. Berlin, Germany. Europe's startup hub, property stall. Berlin hums with innovation, yet the property market tells a quieter story. Prime apartments in Mitte or Charlottenburg hover around $10,500 per square meter, barely moving in 2024. Startups and tech giants keep the city lively, but luxury buyers are cautious. Rent controls and new taxes have added a layer of uncertainty, while Tier 1 transactions dropped 30% since 2022, according to local reports. Sellers are patient, buyers are hesitant, and the city feels paused. Not collapsing, but definitely slowing. For buyers willing to act, Berlin's pause offers a chance to secure prime locations at modest concessions before any rebound. Just a few hundred kilometers south, Frankfurt, Germany's financial heart, shows a different rhythm. Here, high-stakes money meets market nerves, and even well-heeled investors are reconsidering timing. Frankfurt, Germany, finance capital, flat returns. Frankfurt has long been Europe's engine for finance, but the luxury property market tells a quieter story. Prime apartments along the River Main, once trading at $11,000 per square meter, are down about 2% from last year. Corporate relocations that once fueled demand have slowed, and some office conversions into luxury flats have added supply faster than buyers can absorb. Mortgage rates remain high, making even wealthy buyers pause. Agents describe the market as steady, not desperate, with cautious optimism masking a subtle flattening. For buyers ready to move, Frankfurt offers a rare chance to secure central properties at reasonable terms before any recovery takes hold. Head west across the border, and Paris, France, the city of light, is showing a different story, where glamour and price resistance are starting to collide. Paris, France, the city of light, dimmed by rates. Paris still shines, but the sparkle has dulled. In Saint-Germain and the 16th arrondissement, luxury flats once snapped up within weeks now linger on the market. Prices for prime apartments hover around $14,000 per square meter, barely inching up, while total transactions are down roughly 25% from the post-pandemic peak in 2021. High taxes, stricter second home rules, and borrowing costs above 5% keep buyers on the sidelines. Even wealthy international investors are cautious, waiting for signs of stability. For those ready to act, this is an opening. Properties that once felt out of reach are now negotiable, offering a rare chance to secure a foothold in one of the world's most iconic cities. Cross the channel to London, and the story shifts again, with a market that's equally historic but increasingly strained under its own rules. Monaco, even paradise can plateau. Monaco's skyline still gleams, but the market's pace has slowed. In Monte Carlo, penthouses once snapped up for over $60 million now sit longer on listings, as even the ultra-wealthy hesitate. Prices hold their nominal value, around 55,000 euros per square meter, but transaction volumes are dipping, signaling patience over urgency. Developers report slightly higher inventory in older buildings, while newer projects still attract attention, though at a slower clip. For buyers with cash ready, this lull offers a rare window to negotiate in a market usually untouchable. Just a short drive north along the French Riviera, cities like Saint-Tropez and Cannes still dazzle with views, but beneath the glitter, luxury deals are starting to slow, hinting at opportunities for those who move carefully. Nice, Côte d'Azur, France. Dream views, cooling demand. Nice still shines with its turquoise waters and sunlit promenades, but the luxury property market feels quieter than before. Villas once sold in weeks now linger for months, with asking prices around $11 to $12 million. Even the most scenic estates on the hills above the city are seeing fewer offers. Sellers are patient, waiting for the right buyer, and agents note that international buyers, especially from Russia and the Middle East, are holding back. For cash-ready buyers, this pause is a chance to secure prime Côte d'Azur homes at more reasonable terms, a rare window in one of Europe's most exclusive markets. Heading east, the story darkens. Some of Europe's most opulent mansions face sanctions, empty streets, and hesitant buyers, hinting that the next opportunity might be hidden behind political and economic shadows. Moscow, Russia. Sanctions, shadows, and empty mansions. Moscow's luxury streets are quiet in ways that would have seemed impossible a few years ago. Mansions once listed for $15 to $20 million now sit empty, while international buyers are largely frozen out by sanctions. The ultra-prime segment splits sharply. A small group of local elites still moves money quickly, but broader demand has evaporated. Ruble swings make price comparisons tricky, and agents warn that some listings reflect more hope than reality. For patient buyers, this distorted market could hold unusual bargains, though navigating it requires caution and local insight. Shift back to the EU, and the contrast is striking. Here, in cities of historic elegance and long-standing prestige, homes aren't falling into shadows. They're slowing, offering opportunities for buyers willing to act while others hesitate. Vienna, Austria. Imperial elegance, modern weakness. Vienna's streets still shine with imperial elegance, from the Ringstrasse palaces to the quiet corners of the Innere Stadt. Yet behind that beauty, the market is catching its breath. Prime apartments that sold for $3 to $4 million 2 years ago now linger longer on listings, as locals hesitate under rising taxes and inflation worries. International buyers, once a steady stream, are pulling back after interest rate hikes. Developers are pausing new projects, preferring to wait rather than risk overbuilding. For buyers ready to move, this softening could mean access to high-end addresses at prices that don't feel out of reach. Shift north to London and the situation darkens further. Here, historic prestige meets mounting financial pressure, creating one of Europe's trickiest luxury markets to navigate. Prime outer and regional London, UK, the ripple beyond the capital. Even the glittering mansions of Kensington and Mayfair can't hide it. The shockwaves from London's central luxury slump are rippling through the country, leaving once coveted retreats and estates quieter than ever. Prime outer London homes, once selling for $5 to $10 million, now sit longer on the market, with buyers waiting for the right moment. Coastal escapes from East Sussex to Cornwall have shed their pandemic-era premiums, and Savills notes that areas outside the capital are feeling the pull of central weakness. Wealthy investors pause, cautious of overpaying, while listings rise and bidding wars fade. For buyers with patience and insight, this slowdown is a rare chance to access addresses that would have been unreachable just a few years ago. At the heart of it all, the epicenter of Europe's luxury tumble awaits, the city that started the cascade of falling million-dollar homes. Prime outer and regional London, UK, the ripple beyond the capital. London has always been Europe's crown jewel of luxury real estate, but right now that crown is slipping. Prime central areas from Knightsbridge to Belgravia are seeing prices still 20% below their 2014 peak, and in some streets, real losses top 30% when adjusted for inflation. Buyers move cautiously, weighed down by sky-high stamp duties, rising mortgage rates, and global uncertainty. Even trophy homes that would have sparked bidding wars in 2019 now linger on the market for months. Cash buyers are still active, often snapping up the rare bargain, but the broader market feels frozen. Agents quietly cut prices, developers hesitate to launch new projects, and the iconic London energy seems subdued. This isn't a crash, it's a drawn-out correction that's reshaping how Europe views high-end property. For patient buyers, this is a historic window, an opportunity to own addresses that were once untouchable, at a fraction of previous highs. London's slump has sent ripples across the continent from Paris to Munich, revealing cracks in markets that once seemed invincible. London's fall isn't just about property, it's the warning bell for Europe's entire luxury dream. From Brussels' frozen deals to London's long slide, Europe's million-dollar homes are showing they're not invincible. From quiet streets in Prague to the glimmering Riviera slowing down, these cities reveal opportunities for buyers willing to move when others hesitate. Which city surprised you the most? Could you imagine living there, waking up to cobblestones, canals, or sun-soaked coastlines? Drop your thoughts in the comments. If you've ever dreamed about a luxury escape, or just love peeking inside the world of million-dollar homes, like this video. Subscribe too, because your break glass in case of boring life kit is waiting, full of cities, secrets, and a front row seat to Europe's shifting luxury market.